What is going on, y'all? This is Pay Me in Dividends, and today is January 7th, 2025. Now, before we jump into the video, let's do a quick portfolio overview. Today, I am at $91,813. Yes, my portfolio has increased. Why has it increased? Well, I added an additional 100 shares to RDTE. So now I have 200 shares of RDTE. So I have 1,000 shares of AIPI. I have 1,000 shares of MSTY. I now have 200 shares of RDTE at a cost basis of $41.56, and I also have 100 shares of NVDY. Now, if you're wondering, I did tap into some margin over the past couple months. I still have a lot of equity in my portfolio, close to 80% equity in my portfolio, so I'm not too deep into margin. I still have a lot of margin left that I could use, but I'd rather be a bit conservative with it. I don't want to get too deep into margin in this video. I'll cover it in a future video, but again, I did add an additional 100 shares of RDTE to the portfolio in order to accelerate my dividends, right? Because RDTE does pay every single Friday. They do pay weekly, and so I want to accelerate those dividends, and I don't mind tapping into some margin in order to pay for those shares because they will pay themselves off very quickly on a weekly basis. Now, to get into the video, today I want to talk about expense ratios, right? I had a couple people in the comments ask me if I was concerned with expense ratios, which is a great question, right? Because it does matter. It is an expense, and it's something that you should take into consideration when it comes to investment fees or an expense ratio. So let's just start from the ground up, right? Just so we have an idea of exactly what an expense ratio is. So according to Google, an expense ratio is the annual maintenance charge levied by mutual funds or stocks in general to finance its expenses, right? So it includes annual operating costs, management fees, allocation charges, advertising costs, etc., right? Now, I want to dive deeper into it because it's not always black and white as far as a lower expense ratio always meaning that it is a better ETF, right? I want you guys to understand that there's a difference between an actively managed ETF and a passively managed ETF, right? So according to Google, again, we're just going to take this at face value just so that we have a starting point, right? A reasonable expense ratio for an actively managed portfolio is about 0.5% to 0.75%, right? While an expense ratio greater than 1.5% is typically considered high. Now, I want to give you a real life example so that you understand exactly what's going on here, right? So we're going to start off with VOO, right? VOO, which is an S&P 500 ETF, right? It tracks the 500 biggest companies in the US, and it is VOO from Vanguard. Now, their expense ratio, according to their website, is 0.03%. Right? Now, before we dive deep into them, I just want to show you guys the expense ratio for MSTY, right? We're going to use MSTY, Misty, from YieldMax, just as an example in this video, right? So Misty, their expense ratio is 0.99%, right? So you have 0.99% versus VOO that is only 0.03%, right? So on the surface, it may seem that VOO is the better investment, right? Just from investment fee perspective, right? Now, this is where we get into the actively managed versus the passively managed, right? VOO is a very passively managed fund. All they're doing is They are putting money into the S&P 500 and letting it sit there and track the overall market. The only management they really do is a rebalance when the actual index itself rebalances, which is quarterly. So when the S&P 500, right, which is the index that VU tracks, when the S&P 500 rebalances quarterly, that is when VOO rebalances. So that is the bulk of their management activity when it comes to this fund. So in other words, there's not a lot of management going on. Therefore, there's not much reason for them to charge a high expense ratio because they just wouldn't be able to justify it to their customers who buy these ETFs, right? Now, this is not to say that VU is bad. VU is actually probably one of the better investments long term that you can make. You're not going to generate immediate cash flow, but you will be able to track the market, right? If we look at VOO and we look at the performance over the last year, they're up about 25%, which is outstanding, right? So VU is a great investment. However, it is not actively managed, or it's very passively managed. Therefore, the expense ratio is very low, right? Now, let's go back to MSTY, right? MSTY has a much higher expense ratio. But here's the thing, right? If we go to their strategy and what it is they actually do, we can see that the Yield Max MSTR Option Income Strategy ETF is an actively managed fund that seeks to generate monthly income by selling and or writing call options on MicroStrategy. MSTY pursues a strategy that aims to harvest compelling yields while retaining capped participation in the price gains of MicroStrategy. The fund's primary investment objective is to seek current income. So MicroStrategy, or MSTY from YieldMax, is seeking current income by selling and writing call options on MicroStrategy, which means that it is actively managed. They are actively on a daily basis performing options, synthetic options on MicroStrategy in order to extract premium from the options so that they can pay us this huge dividend, right? This huge 127% annual dividend that fluctuates, right, on a month-to-month basis, but typically it's over 100% dividend yield, and they are actively trading and writing synthetic options, and so therefore the expense ratio is higher because, again, the expenses, right, it includes management fees, allocation charges, operating cost, right? I'm sure YieldMax probably has a team of experts who actually sit there and make these trades on a day-to-day basis. So the fees are higher, and the fees are justified because there's more activity in this ETF. So I hope this makes sense, right? Now, to give you a little bit more information, if you don't completely understand yet, right, you can actually go to YieldMax website. And again, I'm just using them as an example because they're very popular in the high yield dividend community. But this is basically how every ETF manager operates, right? So if you go to YieldMax, you can actually download the daily trades, right? So I've already downloaded it. So we're going to look at it, right? We're going to take a look at it. So we can see here, right? Today is January 7th, but this is as of January 6th. You can see for Google, let's scroll to the top. You can see for Tesla, they have 12 open option plays just on January 6th alone. We have ARK ETF, we have Nvidia, right? They have all of these options open just on January 6th, about 24. Amazon, Google. We go down here to MicroStrategy. They have about 20 open option plays on MicroStrategy. So again, this shows you right here that they have so much activity going on. They're performing so many different selling calls and writing calls and just doing synthetic options on these stocks. And so this is a very, very actively managed fund, unlike something like VOO, which again, I'm not telling you that, I'm not saying to base your investment strategy off of expense ratio, but it is something to take into consideration. However, you have to add context to it as well. It's not just, oh, this one has a lower expense ratio, it must be a better investment. You have to look at whether or not it's actively or passively managed, right? Because this is the way I think about it, y'all, right? I'll just be honest with you guys. I don't mind YieldMax charging this expense ratio if that means they're performing all of these covered calls. They're performing all of these option strategies pretty much on my behalf without me having to actually do it. And then they're extracting the premium from those options and paying out this huge dividend. And the only thing I have to do is purchase shares of that ETF and just let them sit and collect the income, right? And so for me personally, I don't mind paying that expense ratio. Now, again, like I spoke about in other videos, you still have to be strategic. You have to be surgical about the investments that you're making. I'm not telling you to jump into every fund just because it's paying a high yield, a high dividend, right? If we look at MicroStrategy over the last year, it's actually returned 46%, right? Just on share price. Plus, it's been paying a very consistent 100 plus dividend yield. So MicroStrategy, I'm kind of cherry picking here, I'll be honest, because this is just insane ETF that has performed amazing. But it is something that I'm invested in, and it just goes to show that just because it pays a high yield and it has a higher expense ratio than your traditional ETFs, it can still outperform the market, right? Now, with that said, I want to go back to my earlier point about not every high yield dividend being good, right? I'm going to show you a horrible investment, in my humble opinion, QQQY, right? First, we'll look at the expense ratio, right? It is identical to MSTY, right? But look at the performance over the last year. This is unacceptable. I would never touch this with a 10-foot pole. It is down almost 40% over the last year. I don't even care how much of a dividend they pay. They can pay 300. I really don't care about how much they pay. This is unacceptable. I would never have something like this in my portfolio, right? So again, guys, it's not about just throwing your money into anything just because it has a high yield. You still want to have trust and belief in the underlying asset, right? AIPI holds a basket of stocks that are in the AI tech sector that I believe in, right? Companies like Palantir are in AIPI, which I believe in long term. MSTY is writing calls on or writing options on MicroStrategy, which MicroStrategy, as we know, as a company, Michael Saylor is one of the biggest Bitcoin holders in the world, top 10. And so Misty has a heavy correlation with Bitcoin, which I believe in long term. RDTE is nice because it pays a weekly dividend, which means you're able to compound your investments that much faster. It also invests into small cap companies, meaning companies that have a smaller market cap, so they might have a bigger potential to make money in the future. And NVDY, the underlying asset, is obviously NVIDIA, which is a leader in their industry. So again, I can go down the list of 4 assets that are in my income portfolio and explain to you exactly why I have my money in them. I'm not just picking and choosing any random, high yield dividend just because it pays 50%. But the reality is, when you look at the chart, over the life of this ETF, it's down 47%. So you pretty much broke even with your portfolio just tanking, and then you're getting taxed on all that income. So you really don't make out good at the end of the day. So not all of these high yield dividend ETFs are good. Some of them are better than others. I just suggest that you do your due diligence and you take all things into consideration, such as an expense ratio. But before you take it into consideration, make sure you understand what it actually is, why an expense ratio is charged, right? Why there is an investment fee, and then go ahead and do your research on that particular stock that you're looking at to understand if the expense ratio is actually justified, right? Which again, for me, MSTY, the 0.99% expense ratio, in my opinion, is justified because of all the activity that they have going on over at YieldMax, right? And so they are working very hard to extract that option premium and pay us out that nice big dividend. So again, guys, I hope that cleared things up on expense ratios. I'm not an expert by any means when it comes to these terms. I'm literally going on Google and looking up these terms to make sure that my understanding is aligned with the actual definition of it. And then I take the definition of it and apply it to my personal portfolio and my actual strategy so that it makes sense to me and so that I'm comfortable putting my money into these investments. So again, guys, I hope that was helpful. I appreciate the people in the comments who are asking these questions, because it shows that you guys are engaged, you guys care about your investments, you care about your money, and you may be looking to put your money into one of these investments. But before you do, you want to make sure you do your due diligence. So again, I always appreciate the questions, guys. Let me know in the comments, what do you think about expense ratios? Did I miss something? Is there something you still don't understand? If I was off on any part of it, let me know, right? Again, I'm not an expert. I'm here to learn just like y'all. This is a process that I'm going through just like you guys, right? So again, as always, super grateful. I appreciate you guys stopping by the channel, and I will catch y'all in the next video.